There is one box on a Social Security form that almost every retiree checks once and never looks at again. And right now, for a huge number of people collecting benefits, that one box is quietly cutting their monthly check by $200, $300, sometimes more than $400. Not because of a new law, not because anything changed this year, because of a decision made years ago on a form most people barely read, a decision nobody at the government is ever going to revisit for you, and a decision that adds up to tens of thousands of dollars by the time it's all said and done. The form is the W-4V. The box controls how much federal tax comes out of your Social Security check before you ever see it. And the mistake isn't always the one you'd expect. Some retirees are having tax withheld that they don't actually owe. Others are withholding at a rate that made sense back when they had a paycheck and hasn't been touched since. And a smaller group is withholding nothing at all, quietly racking up a tax bill they won't see coming until it lands in April. Every one of these groups is losing money right now, and every one of them has a fix that takes a single form and a stamp. If this is your first time here, subscribe now. I've spent years digging into the Social Security rules, tax strategies, and retirement programs that actually move the needle for seniors. No products, no pitches, just the plain English version of what these rules really mean for your check. Subscribe so the next video that could put real money back in your pocket doesn't pass you by. Before we go further, I want to call out two groups of people who are probably listening to this right now, thinking it doesn't apply to them. Both of you are wrong. The first group is the retiree who has tax withheld from their Social Security and assumes the amount must be correct because the Social Security Administration is the one sending the check. That assumption is the most expensive one in this entire video. The SSA didn't pick your withholding rate. You did on a form possibly years ago, possibly while you were still working, possibly when your entire financial picture looked nothing like it does now. The SSA doesn't review that number. It doesn't check it against your tax return. It just keeps running the same instruction, check after check, year after year, whether or not it still makes any sense. The second group is the retiree with no withholding at all, who assumes that means they're keeping every dollar. Half right. No withholding does not mean no tax owed. If your total income, Social Security, pension, IRA withdrawals, investment income, pushes you over a certain threshold, a portion of your benefit is taxable whether you withheld anything or not. Skipping withholding doesn't make that bill disappear. It just delays it, and it shows up later as a lump sum, sometimes with a penalty riding along with it for good measure. Both groups have a version of the same problem. Both groups have the exact same fix. Keep watching. So why doesn't the Social Security Administration just flag this for you? Because that's not their job. The SSA's job is sending your check based on your benefit amount and whatever withholding instruction sits in their file. Tax compliance belongs to a completely different agency with a completely different database that doesn't talk to the SSA's system. The SSA pays you. The IRS calculates what you owed. Neither one is going to call you up and say your numbers don't match anymore. And here's what turns this from an occasional slip-up into something that's costing people money on a massive scale. The W-4V only offers 4 withholding options: 7%, 10%, 12%, or 22% of your monthly check. Most people picked something in the middle, 10 or 12%, because it felt like a reasonable number at the time. Reasonable at the time isn't the same as correct today. Someone whose income has dropped substantially since they retired, who now qualifies for deductions they never claimed back then, may not owe any tax on their Social Security at all anymore. And yet they're still sending a chunk of every check to the federal government, getting 0 interest on it, watching it come back a year later as a refund that was never anyone's money but their own. I've spent years looking closely at how Social Security gets taxed and how retirement income interacts with federal withholding. The situation I see over and over is almost always the same one. Someone who locked in 10% withholding 15 years ago based on the income they had at the time, who is now years into retirement with a much smaller income, who has never once gone back to check whether that number still makes sense, and who has been quietly overpaying the government every single month for years. That money isn't gone forever. It does come back, but it comes back 12 months late, earns nothing while it sits there, and was never the government's to hold in the first place. The fix takes one form. Almost nobody files it because nobody ever told them the original form wasn't permanent. Here's what we're covering. First, exactly how the W-4V works. what each withholding option actually costs you in real dollars, and how to figure out the rate that fits your situation. Second, the provisional income formula, the calculation that decides whether any of your Social Security is taxable in the first place, because for a lot of people watching this, the honest answer is zero. Third, two more moves that directly affect what you owe and can shrink that number even further, completely legally, starting now. Point 1. The W4V. Step 1. Let's kill the biggest misconception first. Most people assume Social Security withholding works like a paycheck did, adjusting automatically as your income and deductions change. It doesn't. Your old employer recalculated your withholding constantly. The SSA does nothing like that. Whatever flat percentage you chose stays exactly where you left it. If you picked a number in 2010, you're still on that number today, unless you personally filed something new. Step 2. Here's the actual mechanics. The W4V is entirely voluntary. You are never required to withhold anything from Social Security. The form gives you 4 choices: 7%, 10%, 12%, or 22% of your gross monthly benefit. Whatever you pick applies to every check going forward forever until you submit a replacement. Picture someone getting $2,200 a month who chose 10% years ago. That's $220 a month, about $2,640 a year sent off in advance. If their real tax liability on that income only comes to a few $100s, the rest comes back as a refund, not a bonus. Their own money, delayed by a year, for nothing. Step 3. This cuts both ways. If you're living mainly on Social Security with a small pension or nothing else, you may find when you run the numbers in Part 2 that none of your benefit is taxable. If that's you, any withholding at all is just an unnecessary advance payment on a tax bill that doesn't exist. If you're in a more comfortable position, pension, IRA withdrawals, investment income stacked on top, some of your Social Security probably is taxable, but the rate you locked in years ago is very likely higher than what you actually owe today, especially if your income has dropped or you've started claiming bigger deductions since then. Step 4. Here's the catch. If you cut your withholding to zero, you need to actually confirm your real liability is zero too, or you're just trading a manageable monthly deduction for one large bill later. The goal isn't necessarily zero. The goal is matching the number to what you actually owe. Step 5. Do this today. Pull up Form W4V from irs.gov. It's 1 page. Fill in your basic information, pick the rate that matches your real liability, or elect to stop withholding entirely if that's what the numbers in Part 2 tell you. Sign it and mail it to your local Social Security office, not the IRS. Processing usually takes a month or 2, and your next check, or the one after, reflects the change. Point 2. Provisional income, the number that decides everything. Step 1. The misconception here is huge. A lot of people assume Social Security is just automatically taxed, full stop, and withholding is simply collecting what's owed. Not true. Whether any of it is taxable depends entirely on a calculation involving your total income, and for plenty of retirees, that calculation comes out to zero. Step 2, here's the formula. Take your adjusted gross income from everything except Social Security, add any tax-exempt interest, add half of your total yearly Social Security benefit. That's your provisional income. For single filers, under $25,000, none of it is taxable. Between $25,000 and $34,000, up to half may be taxable. Above $34,000, up to 85% may be taxable. For married couples filing jointly, $32,000 and $44,000 are the equivalent lines. These thresholds, by the way, have sat frozen for decades without a single inflation adjustment, which is exactly why more retirees keep crossing into taxable territory every year without their actual financial situation changing at all. Step 3. If your income is on the lower end, run this right now. Pension, part-time work, IRA withdrawals, interest, dividends, add it all up, then add half your annual Social Security. Under $25,000 single or $32,000 married, your withholding should be zero. If you've been withholding anyway, you've been prepaying a tax bill that doesn't exist. If you're more comfortable financially, you'll likely land above the threshold, but the taxable slice might be a lot smaller than what you're currently withholding assumes, especially once deductions are factored in. Step 4, the catch. This formula uses income before any deductions are applied. You can't just glance at last year's taxable income and assume it tells you anything about your Social Security exposure. Small things count too, a bit of municipal bond interest, modest part-time income, and they can be enough to push you over the zero tax line. Run the full calculation, not a rough guess. Step 5. Do this today. Grab last year's return. Find your adjusted gross income excluding Social Security. Add tax-exempt interest from your 1040. Add half the benefit total from box 5 of your SSA-1099. Compare it to the thresholds. Under the line, your correct withholding is most likely 0. Over the line, estimate the actual tax on the taxable slice and compare it to what's currently coming out of your check. That gap is exactly what your new W-4V needs to fix. Point 3. Form SSA-44. Fixing your Medicare premium. Step 1. Most people focus entirely on what's getting withheld from their check and completely miss a second leak, the Medicare Part B and Part D premium, specifically the income-based surcharge called IRMAA. The common assumption is that this surcharge is locked in and there's nothing to be done about it. Wrong. It's based on income from 2 years ago, and if your income has dropped since then, you're paying for a financial picture that no longer exists. Step 2. Medicare looks at your tax return from 2 years prior to set this year's premium. Retire at 64, your first year on Medicare gets priced off your last full year of income, even though your actual income may have dropped by half or more the moment you stopped working. Form SSA-44 lets you request a recalculation based on your current income instead of that stale figure, triggered by specific life events. Retirement is on the list, along with reduced work hours, lost pension income, lost income-producing property, and the death of a spouse. Step 3. If your income barely changed at retirement, there's likely no surcharge here to fix. But if you were earning well above the threshold while working and your income dropped meaningfully, this surcharge could be adding a significant amount to your monthly Medicare premium, calculated off a salary you no longer earn. One form triggers the recalculation. Step 4. The catch. SSA-44 requires documentation. A letter from your former employer confirming your retirement date or your final pay stub. Incomplete filings get rejected and sent back, adding months to the process, so get the paperwork together before you submit. Step 5. Do this today. Pull Form SSA-44 from ssa.gov. Check the list of qualifying events on page 2. If you've had one in the past 2 years, fill it out with your current income estimate, attach the documentation, and mail it to your local office. Processing takes 1 to 3 months, and the reduction only applies going forward, never retroactively. So every month you wait is a month you don't get back. Everything so far applies to anyone collecting Social Security, regardless of income level. What's coming next goes a step further, not just matching your withholding to what you owe, but actually shrinking the underlying bill. Bonus 1. Roth conversions. Every dollar pulled from a traditional IRA counts fully toward your provisional income, the exact number that decides how much of your Social Security gets taxed. Roth withdrawals don't carry that baggage. Qualified Roth distributions never enter that calculation at all. That's why some retirees convert traditional IRA funds into a Roth during the lower income years right after leaving work, paying the conversion tax now at a lower rate in exchange for permanently keeping those future withdrawals out of the formula that taxes their Social Security for the rest of their life. This isn't a move to make casually. The math depends entirely on your specific numbers and timeline, so it's worth running past a tax professional before committing to it. Done right, though, it can meaningfully shrink what gets taxed for years to come. Bonus 2. Qualified charitable distributions. If you're 70 and a half or older and already giving to charity, this is worth knowing. A QCD sends money straight from a traditional IRA to a qualified charity. And because that money never shows up as income on your return in the first place, it never touches the provisional income calculation at all, unlike a normal charitable deduction, which only kicks in after that calculation is already locked in. For someone sitting in a higher taxable tier, routing a gift this way instead of writing a check from a regular account can, in the right circumstances, pull them down into a lower tier entirely, on top of the charitable benefit they were already getting. Here's the one idea connecting everything in this video. The Social Security Administration sends your check based on your benefit and whatever withholding instruction is sitting in its file, nothing more. It doesn't check your return. It doesn't notice when your provisional income drops below the line. The IRS calculates what you owed and processes your refund, but it will never call the SSA on your behalf to suggest a change. And Medicare prices your premium off 2-year-old data and keeps charging it that way until you personally step in. 3 systems, 3 separate jobs, and not one of them is built to optimize your outcome. That part is entirely on you. These rules tend to work in your favor more often than anyone administering them will ever volunteer to tell you. The only thing standing between you and a bigger check every month is knowing the system well enough to use it. You have that now. Don't let another month pass before you act on it. Before you go, send this to one person in your life over 65 who's collecting Social Security. A parent, a neighbor, someone from church. Doesn't matter if they're scraping by or comfortable. Anyone who filled out a W-4V once and never looked at it again is very likely getting the wrong number taken out of their check in one direction or the other. That's most people. One conversation, started by this video, could put real money back into someone's check starting next month. Money that already belonged to them, sitting in a withholding account, earning nothing, because nobody ever told them the original form wasn't permanent. Next video, the Medicare form that can claw back an IRMAA overcharge retroactively, going back a full year, a form almost no one files because almost no one knows that retroactive relief is even on the table.